Securities Markets Foundation Part 1, Financial Market Overview. This module sets the stage by defining the financial market, detailing its key components, and focusing on the core concepts of securities and the securities market. The financial market structure. The financial market is the ecosystem where financial assets are created and exchanged. It is broadly composed of various submarkets, investors, issuers, intermediaries, and regulatory bodies. The Indian financial market, for example, is segmented into money market, deals with short-term lending and borrowing, often separated into organized and unorganized segments. Securities market, this is the primary focus, segmented into the primary market and secondary market. Currency market, facilitates the exchange of currencies. Role of the securities market. The securities market provides an institutional and regulated framework for the efficient flow of capital, both equity and debt, from investors, savers, to businesses, users of funds. Its fundamental purpose is the allocation of savings to investments, facilitating capital requirements for business enterprises and the government. Savings are essentially linked to investments through complex financial products known as securities. Definition and features of securities. What are securities? Securities are financial instruments issued by companies, financial institutions, or the government to raise funds. When investors purchase these securities, they convert their savings into financial assets. The legal definition of securities, as per the Securities Contracts Regulation Act 1956, is broad, including traditional instruments, shares, scrips, stocks, bonds, debentures, and other marketable securities. Derivatives, financial instruments whose value is derived from an underlying asset. Collective instruments, units issued by collective investment schemes or mutual funds, excluding unit-linked insurance policies. Specialized instruments, government securities, security receipts, electronic gold receipts, and zero-coupon zero-principal instruments, ZCZP. Core features. A security fundamentally represents the terms of exchange of money between two parties. Dual benefit, issuance allows borrowers to raise funds affordably, while ownership allows investors to convert savings into financial assets providing a return. Rights, investors acquire claims to rights represented by the security, such as ownership, participation in management, or claims on assets. Risk and return, securities are categorized mainly into equity and debt, with varying terms of issue, rights, risk, and potential return. Return is the expected benefit, and risk is the possibility that those benefits may not materialize. Liquidity, the enterprise lists the securities on a stock exchange to ensure they are liquid, can be sold when needed. Securities versus other financial arrangements. A key concept is that securities are transferable standard contracts, which distinguishes them from non-transferable financial arrangements. For instance, a bank's fixed deposit receipt is typically non-transferable, repayable only to the customer, and breaking it may incur penalties. A certificate of deposit, CD, is a security that is transferable. The original customer can sell it to another investor before maturity. Arrangements like bank deposits, insurance policies, and investments in provident pension funds are generally not classified as securities because they are individual contracts that are not easily transferable.